Hi, this is Jeanette Delgado from JD Management Advisory. We provide bookkeeping services for independent medical practices. It's a beautiful day, and I wanted to talk to you today about why your accounting should be based on your documentation and not just your bank statements. Bank statements are only going to reflect the transactions that have actually cleared the bank and won't include the full picture. So when you're looking at a bank statement, you're looking at this or maybe this. So when you want to understand your true financial standing for your business, you've got to be using all of your documentation. It will help you give a full picture to your process, your accounting, and help you make the right decisions based on your true financial standing. So let's look at an example of how this affects your cash flow.
I want to talk to you today about a pet peeve of mine, something that most people don't realize really could affect their financial standing. And that is why you should be using your documentation, not your bank statements, as a way of recording your financial transactions. Most medical practices, as you know, deal with insurance payments and patient payments, various expenses for their medical supplies and CMEs and a multitude of things, just like any other business. And this really holds true for any business of any industry. And the reason why you should be using your documentation, we're going to go into more detail about it, but it really doesn't show the full picture. It only shows a partial picture of your financial standing. It doesn't record things in the proper periods, and it really hides a multitude of problems. You can't detect errors in postings. You can't really understand in a very quick, precise way how you are doing relative to the period that you're in. And it just doesn't really follow the guided principles for accounting. So let's look at what an example of what something like this might look like. So here we have a sample simplified bank statement. We started at the beginning of this March year, 2024, with $20,000 in the bank, according to the bank statement. And then we had various revenues and expenses that most businesses have. This is specific to medical practices. You have patient deposits and received in the office. You also have your EFTs that come in. You have your rent, your medical supplies, your billing software, EHR software, your malpractice, and any loan payments that you might have. At the end of the month, the bank says you had $3,800. Okay, we have money left, and we've recorded expenses and revenue and such. That doesn't look bad. It seems okay. Not a problem. But this is where we get into trouble. Let's move on to what's missing. So we're going to break it down into several areas so that you can really follow and understand what the process is. So we're starting here with the amount that we had left over based on the bank statement. Now, there was a problem because we had a actual $500 deposit from in the office that we've received through the front desk. But when it hit the bank, it only hit for $300. So we were missing $200 in cash had we followed just the bank statement. So this is capturing an error. So what happened to the $200? Did it fall out of the deposit bag? Did it accidentally get left in a drawer? Was there employee theft? So we wouldn't know that there's a discrepancy unless we had posted it based on our deposits for the day that had been reviewed by your manager or whoever else is doing the reconciliation at the end of the day that is not the employee that took in the cash. Also, we had written a check for DMEs This is an orthopedic practice, for example. So they would have DME costs, and we issued the check for $400, but it cleared for $4,000. So there's $3,600 less because it cleared too much. And that happens often where a transaction will hit the bank at a different number. Sometimes it's pennies, but in this case, just for example purposes, and I have seen it, it cleared for a lot more. So if you had not posted your check for 4,000 for 400 in your accounting system, you wouldn't know that it cleared for more because you're just, again, posting based on what the bank statement said. So here we're already going downhill. We're at a zero balance at this point. Then we also have to take into account that you have money that's owed to you. It hasn't been collected, but it's still owed to you. And depending on what your collection ratio is, meaning how fast and how much you can collect on that money, depends on what you should be anticipating coming down the pike. Now, this is not necessarily going to be reported into your accounting system until it hits the bank, but the process of receiving those payments into your bank come in, but you also need to make sure that it's being posted to your billing system, and there's a reconciliation process that should happen, meaning you should compare your banking information of what you've received to what's been posted to the billing system. A lot of times, I have to say about 99% of the time, that is not happening, but it should be happening, and you should have a good understanding on when you should be collecting this money and when you should anticipate it so that you can kind of plan what you're going to need in terms of cash requirements in the bank and to know what you can spend. What else could be missing? Well, there's a bunch of invoices for medical supplies that have not been issued yet. You have invoiced for some repairs in the building that you need to do. You're coming up on your quarterly malpractice, and you don't have that posted in your system, so therefore you're not even anticipating that. Or somebody may have the invoices, but you don't know about it yet, so forth and so on. But as you can see, this invoice for the malpractice was received on 4/1. It's due by mid-April, and that's not even being reflected here. You also have your credit card charges that have not hit the bank yet that you will have to pay. And you also have some unpaid payroll taxes from the last payroll in March that you still owe, but none of this is recorded here, so it doesn't reflect in that $3,800. Additionally, you did in January a big ramp up of reviewing your patient accounts and your patient receivables, and you identified a multitude of refunds that were owed to your patients. And as you should be doing that on a regular basis, you decided to go ahead and start issuing all those checks because technically it's your patient's money, it's not yours. And so all the checks for that cleared, except there were 3 that still haven't cleared as of March. Now, if you don't post that into your accounting system and you're just waiting for it to clear the bank, you can clearly see that you have $2,000 in those checks still outstanding. Additionally, you terminated an employee and you gave them a manual check because you didn't, you wanted just to go ahead and pay them. So you calculated the taxes. You're going to post that into your account. You gave them a check for $2,500, but it didn't get posted into your banking system because, again, you're doing the bank statement, and he hasn't cleared, he hasn't cashed the check yet. So that's also missing. You also have, you just finished your insurance audits, and you owe the insurance company $2,375. That also has not hit the bank, so therefore that's missing. And you took, as a business owner, you took a distribution of $5,000, and you did not tell your bookkeeper yet that that's happened, or whoever's doing your bookkeeping. So that's also missing. So what has happened now is we also have items that you need to include, such as depreciation, although it doesn't affect your financial reports in the P&L side significantly in terms of what your cash effect is, but it is important to record that. And so therefore, to give the full financial picture, especially when it comes to financial statements that you'll have to report to a bank for a loan or for your taxes and so forth and so on, that's important to also record. So in the end, you've got a negative balance in terms of your cash position, because all of these items reflect in one way or another, positive or negative, in your cash position. So as you can see, if you are not posting transactions based on your documentation, but rather through your bank statements, it could really affect how much cash you have in the bank and how much you can anticipate the availability of cash. This is why it's important. So you can have missing deposits that you don't realize are gone. You have amounts that could be clearing for the wrong amount. You have pending invoices that have to be paid, and you have anticipate cash flow for that. You have a multitude of items that will not be appearing on your bank statement, and therefore, but should still be reported in your accounting system, not only for your cash position, but also it's important to have things recorded in a specific period, because this will allow you to do some forecasting and budgeting based on actual trends in your financial standings. It also provides transparency, easy way for you as an owner to run reports very quickly and see where you are at any given time, regardless of whether it's hit your bank or not. It also ensures that you are looking at any surprises and any items that might be coming up that you need to anticipate. And again, it allows for accurate budgeting, forecasting, and identifying trends. So this is how I like to do bookkeeping. I don't want to count on the bank at all times. I need to make sure that we have correct documentation, that we have correct transparency, that we are able to plan and manage your practices on a day-to-day, hour-to-hour, if necessary, or at least have a good understanding from where you stand at all times. And you should be able to, within reasonable time, be able to see this and be able to have anybody produce a report that'll allow you to see this. So again, use your documentation. Make sure that things are being looked at on a regular basis, that it's being posted in a timely fashion, and that way you won't have any surprises in the end. Thank you for your time, and remember, always look at your financial standing as it is in terms of your documentation.
And now that you have seen an example of how these transactions can affect your financial standing, the ones that are missing and the ones that are there on your bank statement, now you can see how it is really important to use your documentation rather than your bank statement to record your transactions and make sure that you have all of the information you need to make the right decisions and to have a complete picture of your financial standing.